Thanks, Kent, for the introduction and kind of following. I'm remembering there's translators. So, obrigado, gracias, thank you for inviting me to the NARA. Hope that translators had some fun with that. That's about the extent of my language skills as well. Just following Lucas's presentation, I had to tell this story because this is a poultry expo, and it's not really relevant to my presentation, but I think you'll get a kick out of this. My kid takes piano lessons, or this is several years ago. And this is in Iowa, so you assume everybody in Iowa knows about agriculture. And she had chickens in her house while she was teaching piano, and she was telling me about feeding them. And she was feeding them salad. I said, "Is that all you're feeding them?" And she said, "Yeah, I want them to be vegetarians." I said, "Chickens aren't vegetarians. They need a complete amino acid profile. This is the industry I work in. You should get some poultry feed and feed it to them. They need meat, otherwise they're going to eat each other." And she goes, "Oh, I didn't know that." So I came back a week later and she said, "I listened to what you said. I got some tofu for my chickens." I said, "I don't know that you were listening." But yeah, today I'm going to, again, thank you to the NARA for inviting me to come and speak. I'm going to give a little bit of an outlook on the animal fats market, talk about the market at present, and then go forward. Before I get started, everybody usually asks, how do you at the Jacobson at Fats Markets come up with the prices that you report? We follow a methodology that's been vetted by IOSCO. That's the International Organization of Securities and Commissions. And basically, they require certain guidelines that make sure when we are reporting prices, doing our process, that it's free from distortion, manipulation. There can't be too much of one party involved in any market. So we do an audit on that. They come through and make sure we do what we're saying we're doing. And really, it's just myself, Chloe Krimmel, who's here, and other members of our team. We talk to buyers, sellers, brokers, traders, find out what's happening in the market. A trade is typically reflected in the price guide. In the absence of trading, we will accept a bid to buy at a higher price as long as it's made to the market as a whole, and offer to sell to the market at a lower price as long as it's made to the market as a whole and confirmed. We'll change the price. And then on occasion, we do what's called an assessed value. So something that might be relatively illiquid, we'll come up with an assessed value on that, but that's very rare. The majority of our prices are based off of trades. Okay, so getting into this a little bit, and here on the left side, going back 2 years. This is a chart looking at poultry fat, FOB Mid-South, Chicago Packer BFT, crude degummed soybean oil, that's nearby futures, assuming it's crude degummed, and then heating oil. So the spread between those two markets, heating oil and soybean oil, is typically what biofuel producers look at. And so a reason I go back this far is I think biofuels, ultimately animal fats are price takers, right? Biofuels are a big part of that price taking. They determine their demand, determines a lot of the price, but there are so many other factors that go into the market that create the volatility that we've seen over the last few years. Going back to and this is my own conversation, I think about before I was in college when 9/11 happened. And I don't know if you remember before that, like the news cycle, the big story at the time was Chandra Levy. That was like the big thing. That was the news that was getting pounded into the cycle, and that whatever June, July, August of 2001. And I remember people saying at the time, like, "God, the news cycle is just so boring. This is a story." And then now you've got ships being attacked in the Red Sea. You've got the invasion of Ukraine. You've got drone attacks. It's like the world's gone fully insane, and that has an impact on the commodity markets. And so you see this big price spike on the left that's largely attributable to the invasion of Ukraine. People thought, hey, there's not going to be any oil, there's not going to be any grains, and there's not going to be any oil seed like sun oil. There's going to be big disruption to the global commodity markets. And it turns out that the speculators, the market gets run up, animal fats go along with it. They're going to follow soybean oil, they're going to follow crude oil, they're going to follow heating oil, and it wasn't as bad. In fact, there was very strong production, I think record wheat production in Russia. And Ukrainian farmers, they couldn't sell their wheat through the Black Sea, so they're kind of dumping into the Western European continent. That's created all sorts of trade issues. That's also weighed on prices. And you see prices here in this region come off. And so that's largely steered by conflict in Eastern Europe. And then here, where you see the next spike in the first part of 2023 is largely attributable to drought. So I live outside of Chicago. I'm in my 40s now, so I obsess about the greenness of my lawn. And to me, the signal when I start to mow less and water more is like, hey, it's really time to start paying attention to the corn market. This is going to start to show up. And sure enough, week after week after week, there's a lack of rain. You start to see commodity prices climb as people are betting we're going to have a tight crop. Genetics and yields are different than what they were 30, 40 years ago. And there's a really strong crop this year. The same thing, people were betting in South America that the market was going to be short. Argentina had a really strong crop. Right now, we're seeing that with soybeans in Brazil and other parts. The weather's better than what initially expected, and that's had an impact on prices. So that's kind of a macro view of what's going on to that. That's a big part of the price dynamic, but zeroing in on the fats market, what has happened to with biofuels demand is just because a lot of people look at biofuel production and they assume, hey, there's all this production going up. It's linear. Production's going to go up, increased demand. That means increased prices on a relatively static supply of animal fats. But that's not the case. A big part of, and how many, just a quick show of hands, how many people here are familiar with the RFS program? So just a really quick explanation. So the RFS, the Renewable Fuel Standard, is the federal program that mandates how many gallons of renewable fuel need to be blended into the U.S. fuel supply. It's ethanol, it's biodiesel, renewable diesel. There's a cellulosic category. The currency of compliance for that is called a RIN. So renewable identification number. So I'm going to talk about this in the following slides, but that's just kind of a primer. There's also the low carbon fuel standard, which is specific to the state of California. That mandates or incentivizes the use of low carbon intensity feedstocks. So use cooking oil, animal fats, soybean oil is in there, but it's preferential to use rendered products in addition to use cooking oil. So as production has increased, particularly relative to the mandate, credit prices have gone down. The people who used to need to buy the stuff to comply with the renewable fuel standard don't need to do that as much anymore because they've started to produce the fuel themselves. So they're well covered. They don't have to go out into the market. And when you look at the supply, it's going up, demand is going down. What's going to happen? Price is going to go down. And that's exactly what's happened to credit prices in the renewable fuels market. As those credit prices have gone down, that's squeezed the margin of biofuel producers. And in turn, that's restricted the amount of money that they are willing to pay for their feedstocks to still operate at a net gain. Several years ago, I think there was a biofuel producer who publicly made their margins, in their public statements that they were making $2.50 a gallon, which is a huge, huge margin. People see that catches the attention of people in a C-suite and an oil refinery and say, we need to start doing this. Well, everybody piles in. You're not going to get 250 margins anymore. And that's what happened. Those margins have really, really narrowed. So that's what's happened. And additionally, there's shifting trade flows. The high prices that were being paid, here and here, have attracted demand from Asia. Previously used cooking oil, there were some imports coming in from Asia, but it wasn't heavily incentivized. Now that there is a higher price being paid, there's a big incentive to bring that in first to Europe because they have double counting for their renewable fuels, and then the United States. So you have big imports coming into the US for tallow for used cooking oil, and that's also weighed on prices. Increased competition gives the sellers our buyers greater optionality, and they're able to leverage that to lower prices. Going a little bit into the renewable fuels mandate. So here's just a look. This is kind of a rough, this isn't exactly to scale, but here you can see the numbers in the bottom left. The domestic renewable fuel capacity in the US, that's biodiesel, renewable diesel, and ethanol, is about 25.5 million gallons or billion gallons. What's interesting about that, into this RFS program, and anything that's in the federal, purview, it's not simple. If you produce a gallon of biodiesel, you generate 1.5 RINs. So that's even more RINs. That's how many RINs are needed to satisfy the mandate, 25.5 billion. If you make a gallon of renewable diesel, you generate 1.7 billion or 1.7 RINs per gallon. So it's even more RINs than that capacity. It's greater than 25.5. Ethanol generates 1 RIN per gallon. So here you see the mandate for 2024 is 21.5 billion RINs. That's a huge spread, a huge overage on capacity versus what is mandated. And you see naturally what's going to happen is that's going to weigh on RIN prices. Additionally, the program allows for a 20% carryover. So you can overproduce in the year prior, bank 20% of those credits and use it for, so 23, you can bank 23 and use it for 24 compliance. And we're hearing that producers overbought last year, anticipating a strong run through Q4. That didn't happen. Producers started to slow down because of poor margins. And so they have a lot in the bank right now that they didn't use that they were planning on using. So basically people are sitting on a lot of RINs. That's weighed on margins, and that in turn is weighed on feedstock prices. Here you can see credit prices for the D4 RIN. That's what's generated on a gallon of biomass-based diesel, how it's steadily declined since late in 2022. And then you can see the same thing with the California program. California's overproduced. They've hit their targets. I can't remember exactly what it was. I think 20%. It's always like a catchy number and it tricks me up, like 20% by 2030 or 30% by 2030. They've already exceeded that carbon threshold. I think, in fact, they may have even been at like a 50% achievement last year. It was 50% of diesel sold in California was renewable diesel. So that program has been wildly successful as intended, and that's weighed on credit prices, which is in turn, the lower that credit price for California, and I'll happy to take questions after this because I know I'm going to this really quickly. But the lower that credit price is for California, the lower that spread is between soybean oil and used cooking oil. So you have a really big LCFS credit price. You got a wide spread between soybean oil and tallow, or say poultry fat, or any other rendered product. You're going to use, if you're a fuel producer, a rendered fat. With that margin or with that credit price going down and that spread between them shrinking, if it's 2 or 3 cents difference, you might think, hey, it's easier for me to put a hedge on with soybean oil. I'll buy more soybean oil. I don't need to go in aggressively for used cooking oil. I don't need to go in aggressively for beef tallow. Here, I can cut back a little bit on that. I can dial up on soybean oil. So we've seen some of that as well, in addition to necessity. Again, going back to a part I touched on earlier, is this growth has incentivized imports, the price and the growth, and that's had an effect on weighing on prices as well. Here's a yellow grease, used cooking oil trade balance. The HS codes don't really differentiate between the two of them, but it gives you a good indication. The purple line is 2023, and you can see that imports massively exceeded exports last year. In fact, there were almost 220,000 metric tons of used cooking oil imported into the US in October. It was about half of that, and actually less than half of that in November. And again, some of that's due to the slower demand, and I think prices coming off as well. Sellers weren't as willing to come into the US as prices have started to decrease. Most of this is coming from China. 49% of the used cooking oil coming into the US is from China. You also have a lot of material coming from Australia, New Zealand, as well as a number of South American countries and Canada. We've started to see imports come from the United Kingdom and from the Netherlands as well, which was previously unheard of because they had double counting in their market, which gave a big incentive to keep used cooking oil into that market. However, that incentivized the import of used cooking oil from Asia. That weighed on their prices, and in turn, some of their sellers started to ship stuff to the US. So it's just the revolving cycle of markets. That makes my job fun as a procurement person or a selling person trying to do an annual budget. I'm sure it's not so fun. US and edible tallow trade balance here. You can see record imports in November. Canada is the biggest importer into the US. I think a lot of that has to do with geography. Additionally, some of those may be re-imports. Some of the stuff being aggregated into the Pacific Northwest or near Toronto, going up and then coming back in after it's been aggregated, potentially processed a bit and being used in renewable fuels. Obviously, Australia, New Zealand, and South America round out the top 6. Those are the cattle growing regions. But those imports have also created competition, which has weighed on prices. One market that's been relatively immune to the import pressure because of lack of a global supply is distillers corn oil. That's the ethanol or the oil that comes out of distillers dry grains. that's centrifuged. That's primarily a US-based product. And so that's been relatively resilient to the pressure from imports, but it has traded negatively in a negative trend because of pressure from the lower margins in renewable fuels. So looking ahead, where we are right now, like as somebody who watches the market every day, I've been having more conversations lately about corn ratios. Like it's been quite a while since people have said, hey, you know, fat's getting pretty well priced relative to corn. I think we're at a floor here. Like you can see here, it was as much as, I think that's 800% in the summer last year. That's not that's not maximizing any inclusion rates and feed mills, but it's getting to the level where we're starting to see more of it work back, or potentially could work back into feed. It's the same thing versus palm. Tallow is, I think, about a 10-cent discount to palm oil in the interior US. So you might see some more palm work its way into animal feed. Some producers I've heard actually prefer non-RIN eligible. So that's based under that RFS program. You have got a slate of feedstocks that are approved for use in biofuel production. Those that aren't approved, like palm oil, have some preference because people say, I don't want to mess with it. I don't want to mess with the cycles here, the volatility. So I don't care if it's 20 cents cheaper, I'm going to use palm. I'm not going to use grease. I don't necessarily believe that. I think the MO has always been low cost formula or least cost formulations drive decisions, and I think that that's somewhat true. So as far as like price goes in the near term, we should be near, fundamentally, we should be at a bottom, but I think that there's a lack of nearby demand that there may be a little bit left on this downside. And that's largely driven by, again, renewable fuel demand. They haven't produced the way that people expected them to start the year. So yeah, 2024 market dynamics, growth in renewable diesel demand. I think everybody was expecting big numbers in January and February. That hasn't necessarily happened. Marathon and Neste have a joint venture in Martinez, California. And so that's anticipated to it's a huge plant. I think it's 750 million gallons. It could be off there, but it's in that neighborhood. 750 million gallons is roughly 5.5 billion pounds of fat. It's a tremendous amount. And then you have another plant, the Phillips 66 plant in Rodeo, California. That's a similar size, similar demand. People were expecting the competition between those plants and the other plants currently running to raise animal fat prices. I think that will certainly happen once these plants start to run as they're intended to. With that said, you still have that margin ceiling. If RINs, you add that extra fuel into the market, you're adding those extra RINs, that pressures RIN prices, that narrows that what people call the credit stack, basically the blender's tax credit plus California credit plus the federal credit, that shrinks that credit, and that lowers the amount of money they can pay for feedstocks. Changing trade flows, again, anticipate more material coming into the US as the demand is there. However, if the US is the lowest priced game in town, look for sellers to go elsewhere. Now, we've already started to see that happen. For the first time in a long time, saw UCO exports leave the Northeast and go to Europe. It's been a long time since that's happened, but the European market is at a substantial premium. It's like 920 delivered ARA right now per metric ton versus, I think, 830 into the Gulf. Static domestic supply, there's no big changes there. Some slight decreases in pork and cattle production. I think broiler production is relatively steady. So no big changes in supply that's going to have a massive impact on the market in the short term. In fact, relatively limited supply, especially the last few weeks due to extreme weather, has probably created a bit of cushion on the downside for this market. Logistics, again, looking at market dynamics, there's always going to be a place for trucks in the interior US market. Traders have done really well taking advantage of that, buying trucks, transloading, putting in rail. But I hear from countless people, especially in the poultry region, who they're very reliant on trucks. They say, I'm happy with my feed customers. Maybe I was making less money in August, September of last year, but I'm making more money now because I don't have to go out begging people to buy my fat. So I think you continue to see pockets of consistency like that, and that relationships do matter in this business. Capacity utilization is the big thing, and that's the term for how hard are these plants running. Right now, capacity utilization is quite low. You've got billions of gallons of capacity. This might be an exaggeration, but that's idle right now because these plants are not like flipping a switch and you just start churning renewable diesel, especially if there's a kind of a flex where you have sustainable aviation fuel or renewable diesel. There can be issues getting those plants running. Diamond Green Diesel, which is the JV with Valero and Darling, seems to be the one plant that has consistently ran very hard. Some of the other plants have struggled a little bit and had some downtime. But with that said, there's a lot of money and a lot of smart engineers behind these projects, and I'm sure that they're going to run. These companies didn't invest the money they did, so they can sit idle. But that's capacity utilization is something to watch. And then again, geopolitical risk. Like I was saying, the headlines have an impact, and what happens in the Middle East is could reverberate through the markets, particularly the oil markets, which could drag prices up because a lot of renewable fuel is pegged to diesel values. Final thoughts, again, big capacity, big demand doesn't necessarily mean big price increases. The more production that's out there on the renewable fuel side, that means the more credits, in theory, the lower the credit prices are because there's less people that need to buy them and there's more people making them. Yeah, but we're going to continue to see a volatile picture. I'd like to say, oh, this is easy to figure out. The market's going to definitely be higher. It's going to be at this price in October. But volatility is going to continue. As you see new market entrants come into the market, things are going to get disrupted and prices aren't always going to be rational or logical. And I think that will continue probably for a couple of years while a better seasonality is figured out and why the market kind of sorts itself out. It's just one of those moments of change in this market. And volatility is a side effect of that. And yeah, margin structure again. Our RIN prices plus LCFS prices plus heating oil. That's essentially the revenue stream of a renewable fuel producer. How that looks relative to the price of fats, that's going to be a good predictor of demand moving forward. And then the big ones are the IRA, and I don't know how we're doing on time, but the IRA, Canada, and sustainable aviation fuel. And these are all really big things. So the IRA is the Inflation Reduction Act. It was passed last year, and there's incentives in there to take the blender's tax credit, which is currently $1 per gallon for producers, to take that and to transform it into a CI weighted tax credit. So it's kind of like California. Instead of getting a straight dollar for your blend, you can get up to, it's $1.50, but you have to use low CI feedstocks. So that increases the demand for used cooking oil, for animal fats, for rendered products. And that kicks in 2025, I believe. Canada, the Clean Fuels Program is starting to gain traction as well. There's very strict traceability requirements to go in there, but that also incentivizes the use of low CI feedstocks. That's a new market or a growing market where people can take some of that extra production and shunt it north, and that helps with the supply of RINs. I should note that too, that is domestic supply. You have foreign generation on those credits as well. So it's even bigger than the domestic capacity that I talked about on credit generation. And then sustainable aviation fuel is the really big one. And that's part of that IRA. There's a lot of tax credits in there. With that said, production still remains relatively limited. A lot of people want to make that. If you think about the demand or the demand pool for jet fuel, it's huge. And animal fats alone can't do it. It's going to take a lot of different sources of fuel production to meet the potential demand that's in the sustainable aviation fuel market. And this is, maybe a conversation for around cocktails, but what's going to happen to the ethanol industry if there's EV penetration? Ethanol demand is a function of gasoline demand. If there's less gasoline demand because there's an electrification of the US fleet, of cars. I'm not saying that's 100% going to happen. It's just food for thought. What's that do for ethanol demand? If there's not as much ethanol demand that weighs on the RFS, where do these ethanol producers go? The logical step is to take ethanol to get their carbon scores down and to go into sustainable aviation fuel. But sustainable aviation fuel represents a big demand point for animal fats as producers ramp up production. But I wouldn't think of it as an augmentation to the current market, more as a transition from road to air and the government's aim to decarbonize everything. And traceability is going to be a big key as well. There's increasing onus because from the government to trace every molecule of fat that goes into a biofuel to generate a biofuel credit. So it's not, you can't just send anything in there. We want to make sure exactly what's going to make this fuel is what it says it is. Use cooking oil. The EPA wants collectors to hand over restaurant lists to the fuel producers. A lot of used cooking oil collectors are saying, no, I'm not giving you my customer list. So there's going to be tensions again. That's the volatility. That's the change. That's the tensions that are in the market in the short term. But yeah, I think I know, again, I went through this pretty quickly, and I'm happy to take any questions that anybody may have, unless Kent, you want to hold them for the panel. Okay. But yeah, that's it on my end. Thank you.